Hello and welcome to the lecture for section 14.1 through 14.8 of your textbook. This deals with accounting, and I will talk about a couple of different things here. One, the role of accounting in society, kind of what it is and why it's necessary. I'll talk about different kinds of accountants, and then I'll briefly talk about the accounting cycle, financial statements, and maybe a little bit about ratio analysis. So my perspective on this for this course is not to teach you to be accountants or to kind of get into the weeds about the rules of accounting and that sort of thing. I teach classes on that I would love to have each of you attend. My goal in this lecture is to instead just let you know what it is and the impact that it has on organizations that you'll all work for. So accountants work in governmental agencies, they work in private enterprises, and they work in nonprofit enterprises. So no matter where you go to work when you're done with college, accounting will be a way that that you're judged. You know, that they keep track of who does well and who doesn't. So I think it's important that you know about it. So accounting is the process of measuring, interpreting, and communicating financial information. So even very small businesses have thousands of transactions that flow through them on a monthly basis. Some businesses have thousands of transactions that happen every hour. So it's a matter of capturing all of those transactions, paying people their wages, collecting cash from customers, providing services to customers, paying the rent, paying advertising. All of these different things are happening all the time. And an accountant needs to capture that information and then arrange it in a way that it tells a coherent story. So accounting is a form of storytelling, and it should answer the question, how did we do and are we going to be okay? Right? Anybody that owns a business or manages a business wants to know that one question at the end of every period, at the end of every month, at the end of every year. How did we do? Are we going to make it? That sort of thing. So again, it applies to all entities. Doesn't matter if you're a department in the state government or if you work for a charitable foundation or certainly for a for-profit business, you want to know that question. So there are users of financial statements, and then there's reasons that they need the financial statements. So if you're an owner or an investor in a company, or you're a creditor, you want to know how the company is doing so that you know, am I going to get a return on my investment? Or if you're a creditor, am I going to get paid back? You're looking to the financial statements to give you that information so that you can make a good decision. If you're in the management of a company, which as university students, chances are pretty good that many of you are going to be managers in the future, you're going to want to know how you did so that you can do a better job in the future, so that you can plan and control the activities for which you're responsible. So you need that information, otherwise you're just shooting in the dark. Employees and union officials need to know because they might engage in contract negotiations. If you're a prospective high-level employee for a company, you might want to know how the company is doing before you jump on board. That's a use of financial information. Lenders and suppliers need to know so they can evaluate whether they're going to get paid on time. And then, of course, government agencies need to know because they want to collect taxes from you. So that's based on how much money you made. So a variety of business activities include accounting to a great degree. So financing activities, that's getting money into the company. So borrowing money, getting money from investors, that's part of accounting. Okay, and companies need cash to live. Okay, investing activities, that's helping answer questions about, should we replace this old truck and get a new truck? Would it be better for us to get a new machine in our warehouse that might be more productive or more efficient than our old machine? Should we be making these parts ourselves, or should we have somebody else make them for us? All of those kinds of questions can be answered by accounting information. And then lastly, operating activities. Where are we doing well and where are we not doing well? So that's another reason you need it. So there are a variety of different kinds of accounting jobs available. A lot of times students think, oh, accountants, that's sitting in the corner doing tax returns. That doesn't sound interesting. Well, that's one very small aspect of accounting. So accountants really fall into three categories. There's public accountants. Those are called CPAs, or certified public accountants. They work for accounting firms and they interact with lots of different businesses and individuals. They might interact with them for auditing. That's going into a company and looking at their financial records and blessing them, saying, yeah, these are accurate, you can trust them. It could be involved, it could be involved in tax preparation, of course, preparing tax returns, helping people legally pay as little tax as possible. Or they could be involved in management consulting, helping companies set up an accounting system so that they can get good information. Managerial accountants work inside a company. So they're employees of the company. They have job titles like cost accountant, internal auditor, tax accountant, controller, chief financial officer, are all jobs within a company, and they all play different roles of being involved in the accounting process. Processing transactions, issuing reports, anticipating the information that management will need and providing it. And then, of course, governmental entities and not-for-profit people, companies, they also need accountants to do the very same thing. So there are a set of accounting standards called Generally Accepted Accounting Standards, or GAAP for short, and that's really all I'll talk about on this page that you really need to know. What that essentially means is that there's a set of rules that all accountants have agreed to go by. So that if you're looking at a set of financial statements, say you're a credit manager at a bank and you're going to approve a loan and you've got multiple different businesses asking you for the loan and you can only approve one, you need some objective way to analyze those different applicants where it's kind of apples to apples. So that means that if all of them have done their financial statements according to these accounting standards, kind of how you account for transactions, then you're going to have a reasonable basis for making comparisons. If everybody's kind of going crazy and doing their own things, it makes it really hard to do that. That's the key thing I want you to take from this slide. So the accounting cycle, and this is a simplified version of that, is when we're going to identify business transactions. So we're going to, anytime money changes hands or the financial condition of the company changes, meaning we've just fulfilled an order and somebody owes us money now, or whatever happens, we get a bill for all the cell phones for our salespeople, anything that happens that changes the financial position of the company is a transaction. So we want to make sure we record all of those transactions in the accounting system so we can see what happened. Those transactions, and those are journal entries, those are posted to ledgers. And think of a ledger like a binder on a shelf that's got a page for every kind of category that we might want to recognize. So one category might be cash. So anytime cash goes in or comes out of the company, we'll record it on that page. Anytime somebody owes us money, that's called accounts receivable. We'll record it on that page. Same thing with every other kind of an account: inventory, expense accounts, revenue accounts. Anytime we sell a product to somebody, we want to record it. So I'll record that in those ledgers so that I can summarize it by account. What's our ending cash balance? What's our total sales? What are our total different kinds of expenses? Then I can prepare a trial balance. That's a listing of all the balances at the end of a period, and make sure everything looks right, that nothing seems off. I can use that list of balances then to prepare financial statements, and I'll describe those in a minute or show you some. And then I can analyze those statements. I can kind of get deeper meaning by making comparisons within those statements to gain additional insight into what's going on in the company. So this is the accounting equation, and it's kind of the foundation for everything else in accounting. So it says that assets, that's what the company owns. So they own their cash in the bank, they own inventory on the shelf, they might own trucks and machines and buildings and computers, all the stuff that the company owns. That's on one side of the equation. The other side of the equation is all the claims that people have on those assets. So that may be people that we borrowed money from. That would be liabilities, or debts is another word for liabilities. So they're first in line, right? If we go out of business, they're going to force those assets to get sold so they can get cash. And then the owners have a claim on the business, right? if we have $1 million in assets and $600,000 in liabilities, that means the owners have a $400,000 claim on the business. If the assets were sold for what we have them listed at, the cash was used to pay the liabilities, they would be $400,000 in that example that would be spread among all the owners of the company. So every time we record a transaction, that equation has to stay in balance. So there are 4 basic financial statements that each tell a different portion of the story about how the company did. So there's the balance sheet. That shows the accounting equation. It says what are the assets that the company has at a given moment in time, usually the last day of the year. What are the liabilities the company has, and what's the owner's claim on the business? So it gives us a snapshot of the financial health of a company. Do they have more assets than they have liabilities, or the other way around? That would give us some insight into whether or not they might be able to pay their bills as they come due. The income statement, also called a profit and loss statement, shows the sales of a company, all the money that they earned by providing products and services to customers, minus the expenses they incurred. So expenses would be like the wages they paid their employees, the rent they paid on their facility, all the materials that went into making the product, advertising that they did, all of the commissions they paid salespeople. Those are all expenses. So if sales minus expenses, if it's a positive number, that'll be a profit. If it's a negative number, it'll be a loss. The statement of owner's equity is a reconciliation of the owner's interest in the business. So it says what was the owner's interest at the beginning of the year. It's going to increase if they were profitable, decrease if they had a loss. It'll increase if they invested more money in the company. It'll decrease if they took money out of the company. Imagine that you work at a bank in 5 years and you're looking at these financial statements for somebody that wants to borrow money from you. You might look at this to say, well, this owner is asking me to lend them money, yet they're taking out as much money as they can. That might tell you that it's not a good company to loan to. And then the last one, the statement of cash flows, that shows where money, where cash is coming from and where it's going to. And that can also give us some insights. So I'll go through these fairly quickly. Here's an example of a portion of the balance sheet. This is the asset portion of a balance sheet, and it shows it for 2 years. And we've provided a little bit more information here by giving some categories of the assets. So we have current assets. Those are assets that we think are going to turn into cash within a year. Okay, so I'll be able to use these assets to pay my bills in the upcoming year. So cash, short-term investments like stocks and bonds, receivables are money that people owe us, and then of course inventory is the stuff on the shelf we hope to sell. Property, plant, and equipment, that's buildings and machines and vehicles and computers and all the longer-term assets we own. Those are things we think are going to last more than a year. And then goodwill and other intangible assets, those are assets that we own that we can't touch and see. So things like patents and trademarks and things like that are also things the company owns. Then we have liabilities. So the liabilities, that's again money that we owe other people. And then we've got stockholders' equity, the owner's claim to the business. So the balance part, you can see at the top there, total assets for this current year are $8,790,000. And total liabilities and equities are $8,790,000. So that's that equation being balanced. Those two have to equal each other. Next one is the income statement. That just shows you sales minus the cost of the stuff we sold. That leaves us with gross profit, what's left over. We deduct operating expenses. Some people call that overhead. That would be like rent, the president's salary, advertising, things like that. That gives us an operating profit. That's kind of how did the core purpose for which we're in business, how did that do? And then we subtract other kinds of expenses to get our earnings before taxes. Of course, we pay taxes, and then we have the bottom line. This is a simplified statement of owner's equity. So it shows, like I mentioned earlier, what the beginning is, and then what increased it and what decreased it, and that gives us what it is at the end. So that's fairly simple. And then the statement of cash flows is going to show us money coming from and going to three different areas. One is operating activities. That's again the core purpose for which we're in business. Investing activities is buying and selling long-term assets. And then financing activities is dealing with long-term debt and dealing with our owners. So that reconciles to say, how did our cash change during the year? Did it go up or down? In order for a company to be sustainable, meaning to be able to continue on financially over the long term, they need to generate cash from operating activities. You can kind of guess that intuitively. If we're losing money or losing cash for the core purpose for which we're in business, and we're making up for that by selling stuff and borrowing money from people, well, eventually we'll run out of stuff to sell and we'll run out of people to borrow from. So here's an example of a horizontal analysis. That simply is just looking at changes in accounts over time, what goes up and what goes down. Some things may jump out at us from that perspective. One of the things I see here is my cost of goods sold is going up faster than my sales are going up. That's not a good trend. My selling expenses are going up faster than my sales are going up. That's not good either. So this kind of analysis would allow me as an owner or a manager to start to ask some questions. Is that an anomaly? Is it a one-time thing? Or is it a permanent trend that might be a problem? Common size analysis puts everything on a percentage basis so that we can make comparisons to other companies that might be bigger or smaller than us that we could benchmark against. That's a way to gain the information about are there areas where we could be doing better. I gave a link to a website there that you can use to find these kind of percentages for just about any type of business you can think of. That's kind of handy if your uncle comes to you and says, boy, my bar isn't making much money, what's wrong? You could look at his financial statements, express them as a percentage, and go to bizstats.com and see what the benchmark is for all bars and compare it as an example. There's a couple of ratios I wanted to tell you about. These are liquidity, which means can they pay their bills on time? That's comparing current assets with current liabilities. A rule of thumb is you want that to be at least 2.0 or more. There are activity ratios, so I can look and see how old is the average receivable. So are people paying their bills on time? I could also look to see how old is the average inventory item, how long has it been on the shelf. That's an important information. If we have cash flow problems, those are two areas that we want to look at to see, are people not paying us on time and are we buying too much stuff and having it sit around? And then there are profitability ratios. The gross profit margin, that's how much is left over after we take away the cost of the goods that we sold. That's on a percentage basis. We want to know, is it getting better or worse? Net profit margin is our bottom line divided by sales. What percentage of our sales makes its way to the bottom line? Is that getting better or worse? And then return on equity, looking at the net income average relative to the average equity in the company. That would tell an investor, is this a good deal or should I invest my money somewhere else? So it's a complicated subject. I just kind of give you a taste of it. If you have any questions, please see me, and I look forward to talking to you in the next lecture. Thank you.